In 2005, a doctor with one eye bet more than $1 billion against the American housing market. He had never worked at a bank. He had never taken a finance class. His medical career ended 3 years into residency. His name was Michael Burry. His fund was called Scion Capital. And the bet was structured so that if housing kept rising, his fund would slowly bleed to death. Here is the situation on the table. It is spring 2005. American home prices have risen for years without a single national decline.
The Federal Reserve sees no bubble. Alan Greenspan, the most respected banker alive, sees no bubble. Burry runs a small stock-picking fund in California. It is working. Since opening in late 2000, through the worst crash in a generation, his fund is up roughly 240%. His investors love him. All he has to do is keep doing the same thing. Instead, he is about to wager the fund itself on one idea. An idea that pays nothing for years. An idea that costs millions every quarter just to keep alive. If he is wrong, the fund dies. If he is early, the fund still dies. What he did next made his own investors try to take their money and run. Put yourself in his chair, because the textbook answer here is obvious. Rule 1 of running other people's money: stay in your lane. Burry's lane was value investing. Buy unloved stocks cheap, sell them fair. That playbook had beaten the market 5 years straight. The S&P 500 lost money in 2001 and 2002. Burry made money both years. That is the record clients were paying for. Rule 2. Do not fight the consensus on a macro call. The data said American house prices had never collapsed nationwide in modern times. Not once since the Great Depression. The Federal Reserve agreed. The rating agencies agreed. AAA meant safe, and the mortgage bonds were stamped AAA. Rule 3. A fund manager who ignores his clients does not keep them. Investors had signed up for stocks. Give them something else, and they walk. When they walk, the fund shrinks, and the fees stop. And there was a brutal precedent for being right too early. Fund managers who bet against the dot-com bubble in 1998 were correct. Most were also dead before the crash paid out. Their investors pulled the money first.
Julian Robertson ran $22 billion at his peak. He called the tech mania a Ponzi pyramid. He was right. His fund still closed in March 2000, the very month the bubble burst. So the textbook move is simple. Keep picking stocks. Keep the clients happy. Let the housing market be someone else's problem. Any rational person would have done exactly this. Burry read the same textbook. Then he did the opposite.
He bet against the entire American mortgage machine. Not by shorting a home builder stock. That would have been the careful version. In May 2005, Burry walked into deals with Goldman Sachs and Deutsche Bank. He bought credit default swaps on subprime mortgage bonds. Insurance that pays out only if those bonds fail. By October, he told investors the position was over $1 billion. His fund managed around half that in stock picks. The bet was bigger than the fund's old identity. And the meter was running. The insurance premiums cost millions every quarter. Every month, housing went up. Scion went down. His investors did not see a visionary. They saw a stock picker who had abandoned his job. By late 2006, the fund was down about 17% on the year. Investors demanded their money back. Even Joel Greenblatt, the legendary investor who had backed Burry from day one, wanted out. Burry's answer made it worse. In October 2006, he used a clause buried in his fund documents. A side pocket. He locked the housing bet so no one could withdraw it. He froze his own clients' money to protect a trade they hated. Some threatened to sue. If the bonds did not fail, there was no plan B. No second fund. No apology tour that fixes this. Then, in early 2007,
The phone started ringing.
Time of death for the housing boom. The second half of 2007. Exactly when Burry said it would die. Subprime lenders started collapsing in the spring. The AAA stamps started cracking in the summer. By 2008, the failures reached the banks themselves. Burry's insurance paid out. Under pressure from his investors, he sold most of the swaps through 2007 at enormous profit. The final accounting reads like a court exhibit. Cyan Capital, from November 2000 to June 2008, up 489% after fees. The S&P 500 over the same window, about 2%. The housing bet produced roughly $700 million for the investors who had tried to fire him, about $100 million for Burry himself. So, autopsy. Was this vision or a lottery ticket? 3 findings. Finding 1. Information asymmetry. Burry was not guessing about a feeling. He read subprime bond prospectuses. Hundreds of them. Public documents. Free to anyone. Read by almost no one. Inside them, he tracked the loans backing each bond. Down payments shrinking. Income verification disappearing. Teaser rate loans that reset to unpayable levels roughly 2 years after signing. That reset clause was a timestamp. The worst loans were written in 2005. 2 years later meant 2007. He wrote that date to clients in advance. His words, quote, "The mortgage market would melt down in the second half of 2007. End quote. He did not predict a storm. He read the timer on the bomb. Finding 2. The safe option was not safe. Staying in stocks meant standing inside the same economy the bomb was wired to. When the crash came, the S&P lost roughly half its value. The consensus position, trust the AAA, trust the Fed, is what actually destroyed portfolios. The real risk in Burry's trade was never the analysis. It was the clock. Premiums bleeding out, clients pulling capital, Wall Street marking his positions against him. He nearly died of impatience, not error. And here is the detail most retellings skip. The side pocket clause that saved the trade was not improvised. It sat in his fund documents from the start. He had built a legal bunker for the day his own clients would doubt him. That is preparation, not panic. Finding 3. The cost of the textbook. Follow the rules, stay in your lane, honor redemptions, and Cyan sells the swaps at the bottom of 2006 to pay exiting clients. The trade dies 18 months before payout. The investors get their money back, then watch the crash shred it in their next fund. The textbook did not protect anyone in 2008. It just decided who was holding the loss. One caveat, for the record. Burry's swaps needed Goldman Sachs and Deutsche Bank alive to pay him. In 2008, that was closer than anyone likes to admit. The government rescue of the banking system quietly protected his winnings too. Keep that on file. It matters for the verdict. The case for luck. His timing nearly killed him. His own clients nearly killed him. And the banks that owed him money nearly died before paying. The case for genius. He found public evidence nobody read, dated the collapse from the loan resets, sized the bet to survive, and pre-built the legal lock that kept it alive. Here is the test this channel always applies. Genius is when the logic works before you know the outcome. Run it. In 2005, was the logic sound with the information he had then? Yes. The prospectuses were real. The resets were contractual. The date was printed inside the loans themselves. 5 years later, Burry put it in one sentence. Anyone who studied the markets carefully in 2003, 4, and 5 could have seen the risk. The outcome needed some luck. The analysis needed none. Verdict. Calculated genius. Not because he made a fortune, because the reasoning was checkable before the crash. and no one bothered to check. That's my verdict. What's yours? Here's the question for the comments. If your fund manager froze your money to protect a bet you hated, and it worked, do you thank him or fire him anyway? And if you want the opposite specimen, a man who bet everything with no evidence at all and still won, the next autopsy on this channel is for you.